Howdy, Jacob here. Today we're looking at NVR in the household durables industry. I currently own a Ryan's Homes home, which was acquired by NVR. And so um, my experience was not fantastic. I mean, I'd say the townhome that I have is done very mediocrely, which makes sense. Our community is 200 homes or such. So, I mean, they just kind of rushed it. But from a company perspective, obviously, I think that their ability to buy back shares historically has been some of the most impressive that I've ever seen. And when you're looking at companies in your coffee can approach, your hunter beggar, NVR is a great example of one that through the repurchasing of shares has definitely increased shares just incredibly. So we can see that in 1991, the price was $1 and is now $7,000 now. So incredible growth there. Even since, I mean, it's not a 100 bagger since down here, but definitely a 10 bagger even since, what is this, $76, 2012 of March or so. It's been a 100 bagger since then. So, or 10 bagger, sorry, since then. So we're looking at a company that does a great job of repurchasing shares. You don't see as much here because it's just 4 million out of 3 million, but um, they've historically bought back an enormous amount of shares, and the company's growth has been way less. But basically, when you look at an earnings per share perspective, we see that revenue is basically doubled, a little bit more than doubled, and the earnings per share is 6, 7 times greater than their 10 years ago earnings per share. So through also, just increasing the operating profit of your company, the ability to buy back shares can really increase this. And this is, again, just 10 years. If we look at it from a 30, 40 years ago standpoint, we'd see that the number of shares have just been decimated, which is one aspect of a few for Hunter Bagger, looking for Hunter Bagger stocks. So 23.9 billion market cap on 21.6 billion enterprise value. Fantastic returns on invested capital. But as I always say, when you repurchase shares, that does inflate this figure, which they've been repurchasing shares, like I've said, for a while now. So that is pretty inflated, but very great return on invested capital historically still. Great return on equity, return on assets, everything. Their margins are increasing on both operating margin side, almost double, gross margin side up 6%, and revenue growth almost double, or revenue is almost double what it was 10 years ago. Balance sheet has 3.1 billion cash on hand and 2.2 in all of their liabilities. So from a balance sheet perspective, extraordinarily safe, very little debt, especially in relation to the cash on hand. They have enough money to pay a check and write off all their debt, which is fantastic. From a free cash flow perspective, very little capital expenditures. I haven't read too much into the business, but I heard that they actually get like a loan for the land and they don't actually ever own it. So their inventories are always very low for a home building company. But they just, while they're looking for permits, if things fall through, they basically just, they like almost rented the land essentially. And again, I think I've heard this somewhere, I've read it somewhere, but they basically they don't buy the plot of land before they build all the houses. They actually like rent the land before they get their permits and make sure everything's all good. And then through the bank or someone, they'll purchase the land and then build the homes there, make a fat profit. Which we do see. I mean, expansive cash from operations with capital expenditures actually lower than they were 10 years ago. So very incredible from a business standpoint. Their cash flow statement, amazing income statement, balance sheet, everything is amazing. But are we buying it for the right price? That's what we'll determine now. On the revenue growth side, I mean, I don't think houses are going anywhere. It changes pretty often, but I think of homes that are on the market, I think roughly 10% are new, 90% are existing pre-existing homes. And I think a lot of places, I mean, the world's in demand, or U.S. increasing population. I think a lot of particular places, I think NVR is good at going to places that are increasing. I mean, um, let's see, West Pennsylvania, Indiana, Tennessee growing like crazy, Washington, D.C. So yeah, I think they'll do a great job at making stuff in the right area. I think mortgage rates are probably hurting them right now. I think people are scared to pay for a house with a 7% mortgage rate, looking at their monthly expenses when they can technically own a house 50% greater at a 50% reduced mortgage rate. But I do think that the new people or people that buy a home, people that buy a home aren't as affected by it. I think people that are just getting out of the college and everything and aren't very experienced with mortgage rates might not know a difference, since in relation to the last 50, 60 years we're actually at average. Obviously in relation to the 20 teens and early 2020, 2021, our interest rates are crazy high, but in relation to the actual long history, half a century of that's not even long in relation to the world, but the last 50 years is actually pretty average and might actually be considered low due to the fact that the 80s rates were as crazy high as they were. So I do think they'll still grow pretty substantially. I think 7% seems pretty reasonable to me. 18 on the P and price free cash flow, because they have been growing so consistently, and they're a very consistent company. People love consistency. People love growth. People love share repurchases and a long history of it. And margins are very similar, but have been growing. So maybe let's do 14 and 15, a little bit of a range there. Let's do minus 3%. That would be about $240 million. Their 5-year free cash flow of about $800 million. Let's see. So 240 equals 240 times 4. That'd be about 960. I mean, they could probably afford 4% of shares a year. I think that seems pretty reasonable to me, because they're not really paying a dividend. They're probably reinvesting a little bit back into themselves and making a little bit of acquisitions, but really they've been just very heavy at share repurchases. So I honestly think 4% seems pretty reasonable. And with these assumptions, we're saying it needs to fall another 20% before you get a buy. I mean, interesting. We're not too far off for me to do more research on this business. I wonder if this PE makes sense. I wonder if these margins make sense, because historically they have been a little bit lower. So maybe I'm being a little frothy there. But yeah, I guess we'll see when it drops a bit more before I do more research. But I do hope you enjoy the video. Have a great rest of your day. Thanks.